So let's jump to your big deal. I think it's fair to say in 2023, you bought the German portfolio of Silicon Valley Bank. How did that deal come about?
We had been working on our fundamentals for a long time. I think in our partnership, we have a person who's the only one outside Bootstrap who has ever bought a venture debt book before. So Humphrey Noakes, who's British, in the late 90s or early 2000, acquired a venture debt book from an American lender also, GATX.
So just one of your colleagues had ever done this kind of big secondary style transaction?
Yeah, we had never seen that in Europe. And another one of our partner, Elliot, is ex-SVB, helped launch their fintech franchise here in the very early days of Silicon Valley.
He was already on board with you before you did.
He was already on board with us. He joined us way before all of that happened. And when SVB folded, unfortunately, we knew that First Citizen acquired the American assets really quickly. HSBC grabbed the UK assets very quickly as well. But we knew that the German assets were still up for grab. And so since March, we had been trying to get in touch with the US FDIC to understand how they were going to dispose of those assets. So they started a process led by a Midwest corporate finance firm that started it in June, just before European summer, when everybody was starting to pack up and go. Obviously we had been like sharpening our underwriting knives. And so when they launched the process, we were one of the teams who had the skills to really understand that portfolio, because it was a performing portfolio. Great assets in Germany. SVB had done a lot of work educating the ecosystem around venture debt, the same as they've done in the UK. So Germany was their only other market in Europe where they had like a bank presence. And so they grabbed a lot of amazing portfolio companies, often financed by US VCs. So the likes of NEA, Inside Partners, etc., that you don't necessarily see a lot in Europe. As you said, the crème de la crème. And within less than a month, we could analyze all those transactions with our team. So we also have people who have been on senior bond desks at Citi, others who knew how to do hedging and FX, others who knew how to do NAV financing, for example, for loan acquisitions. And
so you found you had the talent in-house.
We had
even though you'd not done this specifically before.
Exactly. We're not a secondaries team, but we knew the loan book and we knew how to structure those transactions. And I think while some of our competitors were still at the stage of writing and signing, negotiating NDA with the FDIC, we had finalized the transaction. So it was a matter of speed and skills. And again, I think it's really the team that made it happen.
And what about kind of pricing? I mean, it's valuations must be difficult in that part of the market where everything's loss-making, presumably, and all is about potential.
Well, it's interesting because if you think of some of the large US auto manufacturers who were loss-making at some point, they still had very well-rated bonds out there, because even though they were loss-making, they could still pay their debt obligations. And it's exactly the same in venture debt. Even though the companies are loss-making, they're well-capitalized and they can pay their loan obligations. So the SVB portfolio in Germany was well-performing. There were a couple of positions we knew were not doing so well. We could provision them and we could really, basically risk weight them. But the rest of the portfolio did fantastic. So it was a matter of understanding where the pieces of risk were lying in the portfolio and accurately pricing it. I think only the specialized lenders could do that. We knew that some banks were bidding for it also, because we contacted them for financing and they were conflicted.
So hence your ability to be nimble, because presumably you were up against banks rather than other small providers like you, or everyone.
I think everyone who is someone in venture lending in Europe looked at it. Our competitors looked at it. Our competitors bid for it. So it was not a distressed sale. The seller was distressed, but not the seller.
Yeah. So people might not understand this. I mean, what was the problem with Silicon Valley Bank if it wasn't their portfolio?
So I was alluding to how, as a lender, you finance yourself.
Yeah.
And Silicon Valley Bank finance themselves also with debt. It's very common in the US, actually. Other listed lenders finance themselves with debt. We don't believe that is necessarily the right model. But SVB did not manage really well the match between their assets and the liability side of the bank. So the debt tranching and the debt maturities and the way they locked the interest rates.
Right.
On the liability side, made it very expensive for them to repay their obligations. And so, unfortunately, it folded, which truly, I think it was a net loss for the system when it happened. But it's impressive how quickly it recovered.
Right. Yeah, so it's a kind of a treasury management issue, nothing really to do with fundamental venture capital.
Correct. And you can see how quickly the other banks jumped into the pond after Silicon Valley Bank disappeared. So the JP Morgans, HSBC, all came into this market because you're talking about companies who have enormous deposits compared to your usual SME. You know, a venture-backed company has a couple of tens of millions on its balance sheet at any given time, the ones who are doing well. And whereas normally an SME would have very short liquidities.
Yeah.
Right. And so that, I think SVB has something like 100 billion of liquidities. You know, don't quote me on this, but I can't remember the exact number, but they had enormous liquidity that all the banks then jumped onto to try and get those deposits.